an economy like the UK is a very good example. So, in my work, I've argued that the UK is almost a quintessential example of a kind of a rentier capitalist economy where rentiers are so very, very dominant, and the economy is so very, very oriented towards rentier interests and activities. And it's absolutely no coincidence that the UK, during the period in which it has become more oriented towards rentier interests and activities, has become a very, very stagnant economy characterized by very low growth rates, low rates of productivity, and B, a very, very unequal economy as well. All of that is readily explicable by its shift towards a more rentier type economy. So what can governments do? Well, I think that, let's say two or three key things. Well, let's focus on two. So one, I think, which is very, very important.
Hello and welcome to another episode of India and Global Left. Today we have with us a very, very special guest, Brett Christophers. Brett is an economic geographer who is professor at the Institute for Housing and Urban Research at Uppsala University. He has written extensively on the history of the modern financial sector, the financial management of real economic assets, and the effect on the environment from financial management of land and natural resources. Brett, welcome to India and Global Left.
Thanks so much for having me. It's great to be with you.
I wanted to start with your work on asset managers of the alternative investment funds. And I think it's very, very helpful to understand what's going on right at the top of the capital markets and its impact, which is usually very, very less visible, and also what is its impact on the world we inhabit. So just for our viewers, if you can explain what these alternative investment funds are, what do the asset managers of these investment funds do, and what is its impact on the real world we live in?
Okay, yeah, there's quite a lot to cover in that question. So I'll do it as, I guess, simply and as kind of high level as I can, but without kind of oversimplifying things. So basically, there are a set of financial institutions in the world called asset managers who have become much, much more significant in recent decades than they were previously. And what asset managers do, in very, very basic terms, their defining feature, I suppose, is what they do is they invest money on behalf of others. So that's what distinguishes them from other types of investment institutions, which is the fact that almost all the money, and in some cases all of the money that they invest, is not theirs. So they invest predominantly on behalf of others. Those others can be institutions, they can be individuals. And for carrying out that investment service on others' behalf, they earn fees of various kinds. So that's what asset managers do. Now, if you go back to before the 1980s or so, when asset managers carried out their investment on behalf of their clients, essentially all of that investment comprised investment in financial assets of various kinds, predominantly shares, so shares in corporations, and bonds, so bonds issued either by corporations or by governments. So they were buying financial assets that were, in most cases, assets that were listed on public markets, so on stock exchanges around the world. Now, something began then to change in the 1980s and 1990s, which was that as well as investing in financial assets, they also began to undertake growing amounts of investment in what in the industry are referred to as real assets, which basically means they began buying physical stuff. And as far as I'm concerned, the really important physical stuff they began to buy were large scale physical assets that play a really, really important role in people's lives. And so the examples that I've studied are predominantly twofold. So the first of those is housing. So they began to buy, particularly in the 90s, they began to buy increasing amounts of housing of various kinds. So that could be, apartment blocks, it could be student housing, it could be mobile home communities, it could be single family housing, all the rest of it. So that was the first thing they began doing. And then the other thing they began doing was putting money into physical infrastructures of various kinds. And these were and are infrastructures that play a really important role in people's lives because they are the infrastructures through which many of our most important kind of public services are delivered. And so I'm thinking about things like energy infrastructures, water and wastewater infrastructures, telecommunications infrastructures, transportation infrastructures, so roads, parking systems, bridges, things like that. And so today, asset managers have become very, very significant owners of housing and of all these different types of infrastructure. And so just to give you one example of that, the company which is the biggest asset manager owner of infrastructure in the world, which is an Australian headquartered company called Macquarie, it estimates that every day something like 100 million people around the world use the infrastructure, rely upon the infrastructures that it owns. So it's a huge owner of these things. And my argument that I've been trying to make is that this is a big deal. And it's a big deal because asset managers are a particular type of entity. They have certain incentives, they have certain fee structures that, in my view, mean that they're actually quite inappropriate owners of these infrastructures. And the reason I say that is that I think, on the one hand, they tend to be even more relentlessly focused on extracting as much income from those assets than other types of owners of those assets. So, for example, if you are living in housing owned by one of these actors, evidence suggests that you're going to have much stronger upwards pressure on the rents that you pay than if you had another type of owner. So that's the first thing. And then the second thing is that because, well, for several reasons, but one of the main reasons is that because they tend to be quite short-term investors, so they typically don't hold these assets for a very long period of time, they tend not to be particularly good at carrying out the long-term maintenance and upgrades of these infrastructures that obviously are very important for these types of infrastructures. We need our water and energy infrastructures, for example, and housing to be well maintained for the long term and not to have them controlled by short-term oriented actors. So that's basically, in a nutshell, the argument that I've been trying to make about these asset managers and their growing investment in real assets.
When you use the word buy or owning, I think what you are basically saying is that it's almost a pyramidal structure of how money is flowing up and managed. There are households at the bottom or high net worth individuals, and these money go into these pools like pension funds or into insurance companies and so on, whose money is being managed by these asset managers that you are talking about. So they are not necessarily owners. Would you explain a little bit on how this pyramid works?
Yeah, no, that's exactly right. So you're 100% right. So, for example, if a So the way in which a company like Macquarie, to stick with the example that I've used already, the way in which it invests is it will establish one or more investment funds, which are essentially kind of collective investment vehicles. That's what they are. And so what they'll do is they say, okay, we're going to establish a fund, and that fund is going to focus on investing in, for example, infrastructure of various types in India. Okay, that might be kind of solar farms, it might be toll roads, it might be farmland, all sorts of other kind of real assets. What it will then do is it will kind of go on the road, so to speak, and it will go and talk to predominantly to institutional investors like pension funds, sovereign wealth funds, and so on. But pension funds are very, very important, and it will say to the managers of those funds, look, we've established this vehicle. We think this is going to be a good investment for you. So we would like you to commit a certain amount of capital to this fund. And so Macquarie might set up this fund, and over the course of a year and a half, it might raise, say, let's say $10 billion to put into this fund. And that is the money that it then invests in those infrastructures in India. So the money that it is investing is money that has been put into that fund by public pension schemes, insurance companies, and all the rest of it. And maybe only 1 or 2% of the money in that fund will be Macquarie's own money. So you will often read in the newspaper that say there'll be a report that says Macquarie has bought a portfolio of toll roads in Kerala, for example. But in reality, that's not an accurate, as you say, that's not an accurate framing, because it's not really that Macquarie has bought it. The entity that has bought it is an investment fund managed by Macquarie. And of course, insofar as the money in that fund is predominantly not Macquarie's, the actual owners going forward of those toll roads are those who have put money into the fund. It's as you say, it's at the end of the day, in large part, it's the pensioners, the likes of you and I, whose money is being managed by those pension scheme trustees, which the pension scheme trustees have in turn given to Macquarie to invest in these things. So you end up in really strange situations. This one way to think about it is this, which is to say that you could have a say a nurse or a firefighter living in California, renting an apartment in California, and that nurse could have their pension, their retirement savings, could be managed by a trustee who has given some of that money to an asset manager like Blackstone, who in turn has invested that money by buying the apartment block in which that nurse lives. So in a way, the nurse owns a very, 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 in that case, owns a tiny, tiny share of the apartment in which they're living, and almost certainly would have no awareness of the fact that that is actually the case.
One of the things I liked about your work is that you also show that the composition of these investment funds also tells us that they hold only a tiny, tiny percentage of ordinary workers' money. Even the pension funds are mostly coming from the richer people, but also within the larger pool of investment funds, it's the sovereign wealth funds and other types of funds apart from the pension of the ordinary workers.
Yes.
And eventually, because rent is rising, prices are rising, because they are invested in terms of their short-termism or profitability, they lose out much more than what they could even gain, even in terms of this very small ownership.
Yeah. Correct. And I think this is important. And I think one of the reasons it's important has to do with the particular way in which the big asset managers justify what they do. So as many people listening to this will know, I'm sure, the likes of Macquarie and Blackstone and BlackRock, the big asset managers who invest in real assets, they come in for quite a lot of criticism from the likes of me, but not just the likes of me, but from activists, certain politicians of certain political stripes, and so on, for what they do. And one of the main ways in which they defend themselves is they say, look, yes, we have these funds that we invest, and sometimes they make super profits. But that's a good thing, because those who we are making money for are the ordinary nurses and firefighters and teachers whose money it is that we're actually investing. So you should want us to make lots of money, because we are making money on behalf of kind of people who everyone should want to do well, nurses and teachers and firefighters. And you're right, I debunk that argument, and there are the two main ways in which I do that are to say well, if these funds do perform well, actually a lot of the money goes to the fund manager, goes to the Blackstone, rather than those whose money they're investing, because of the types of fee structure that these funds have. So the asset manager actually does disproportionately well. And in fact, when these funds perform very, very poorly, which they sometimes do, they lose money sometimes, the asset manager still does well, and everyone else loses all of their money, basically. So that's the first reason, is that the asset manager takes a big chunk of the profits where profits are generated. The second thing is, as you say, is that when you look at the money that's going into these funds, yes, a significant share of it is retirement savings, but a significant share of it is not retirement savings and is coming from banks and insurance companies and sovereign wealth funds and the rest of it. And B, that money, which is retirement savings, is predominantly not the retirement savings of ordinary workers. It's the retirement savings of very, very wealthy individuals, because retirement savings wealth, pension wealth, like all forms of financial wealth, is very, very unevenly distributed in society. So the Blackstones and so on will say it's ordinary workers whose money we're investing. But in reality, that's not true. Ordinary workers' savings represent only a tiny sliver of the money they are actually investing.
I think this is a kind of good segue into the larger picture of capitalism, and I want to focus a little bit on the growing literature of rentierism, rentier capitalism, on which you have written a book about. And I think the question I would like to start with is, the asset managers of investment funds, the alternative investment funds, are one segment of the capital markets, but there are the traditional sort of bond markets and stock markets, or the banking market and so on, which has also come under fire from a growing range of literature that's critical about this kind of rentier capitalism. So it's not just Blackstone and Carlyle or Macquarie, but it's also BlackRock's and the Vanguards and the State Street. But it's not just about the fund manager, which also multinational corporations integrating technology and how that is leading to rent collection, monopoly rents, and so on and so forth. So how do you place the larger group, or how would you define who rentier capitalists are?
Yeah, that's a challenging question. So I think that in order to answer that question, we need to define some basic terms here. I think it's very, very important to do that. And then I think once we've done that, it'll be easier to kind of try and answer that question that you've elaborated there. And so the key term is obviously rent, and what do we mean by the term rent? And again, as I'm sure loads of people listening to this will know, the term rent is one that gets used in a myriad different ways by different people and different commentators. And in fact, it's a really difficult term to come to terms with, precisely because two people can be using the same term and mean completely different things by it. And in what I've written about this, what I like to say, and I think it's a reasonably useful way of approaching this, is that there are, excuse me, there are two kind of main traditions of thinking within, I guess, economic thought in general about what rent is and how we should understand it. There's basically like a mainstream tradition and a kind of alternative or heterodox tradition. So for the mainstream tradition, rent is basically understood as a form of excess profit. And so what they mean by that is that if we think about competitive markets, for whatever product or service we're talking about, that if you have a competitive market, there will be a certain level of profit that is obtainable in that market. What they then say is that if you have a degree of market power, monopoly power, or oligopoly power in a market, there will be higher levels of profit available in that market. And what they mean by rent is essentially that excess level of profit that is available by virtue of the relative absence of competitive forces. So it's an excess profit over and above that which is available in competitive markets. So that's kind of the mainstream perspective on rent. In the heterodox tradition, rent is thought about quite differently from that. And I would say that the main way in which rent is understood and defined in the heterodox tradition is a form of income that is available, a form of income that is generated and earned by virtue of the ownership or control of a scarce asset of some kind. So it's about asset control, and of course, the classic rent generating asset is land. So when the classical economists talked about rent, it was land that they were typically talking about. So if you own and if you have exclusive ownership rights to a piece of land that others want to use, whether for to grow crops or to have housing on or whatever else it might be, you can earn income from by virtue of that control, and that is a form of rent. Now, what the heterodox tradition also says is that over time within capitalism, you have had a kind of proliferation of the different types of assets that generate these incomes that we can refer to as being a form of rent. And so today, land is by no means the only such asset that generates rent. You can think about things like intellectual property, so patents or trademarks or copyright, which they're forms of property like land, but they are, in a sense, that help you to generate income because they prevent competitors from producing the same pharmaceutical products or whatever else it might be. You can have financial assets that also generate rent. You can have infrastructures that help generate rent, and you can have digital platforms that help generate rent. So things like Airbnb or things like that. So there's a whole slew of different assets today that generate rent. And so if that's what rent is, a rentier is an economic actor. It can be an individual, but it can also be a company, of course, that derives income, all of its income, or even just part of its income, that is at some level rent So a company that, like Airbnb, for example, should be thought of as a rentier because it makes its money by virtue of the fact that it controls this platform that generates rents by mediating the relationship between other different actors, and it kind of siphons off the rent from doing that. So if that's what a rentier is. So rentier capitalism, again, different people use that term in different ways, but for me, I see rentier capitalism as a kind of a form of capitalism in which rent and rentiers are very, very prominent. So it's a form of capitalism which a significant share of the overall income that is being generated within that economic system represents rent, and within which rentiers have become very, very prominent actors. Now, I know I've talked for a long time. Let me just say two other things that I think are important there. So the first comes back to your particular question about asset managers. So insofar as asset managers invest in assets that are rent generating assets, whether it's housing or toll roads or whatever else it might be, they are classical rentier institutions. That's what they're doing. They are rentiers. So for me, asset managers represent a very significant subset of rentier capitalist institutions more broadly. So that's the first thing to say. The second thing to say is kind of how I understand rentier capitalism within a longer durée type perspective. So my argument is not that what we have today is rentier capitalism that has in some sense kind of superseded or replaced a form of capitalism where there was no rent or rentiers. That's absolutely not the argument at all. Capitalism has always had rent, and capitalism has always had rentiers. So, but what I see rentier capitalism as, is a historic phase within capitalism where rent and rentiers are particularly prominent. So they are more prominent than they have been before. But as I say, there have always been rent and rentiers within capitalism. So it's completely wrong, in my view, to think that you can have kind of rentier capitalism and non-rentier capitalism. No, capitalism, rent and rentiers are inherent to capitalism. They're part and parcel of capitalism. But capitalism in different times and places can be more or less rentierist in nature.
Yeah, I liked this understanding that rent has always been part of capitalism for both historical regions, because if one goes deeper into history, there are always these cycles of accumulation, as Arrighi called it, where there would be more rent-seeking activities in certain parts of the world, and then the productive sector might move. And when you have this global perspective, you realize how long, deep into history that goes. So that's like the more historical reasoning. And I think even analytically, it's important to understand that all rent-seeking activities, whether it's Uber or whether it's Amazon, they also in parallel offer services, generate employments, give workers its ways, maybe sometimes very bad, sometimes very good to some workers. And so it's the sort of dominance of the rentiers that defines this as a phase of rentier capitalism.
Correct, absolutely right.
I think one thing that I wanted to discuss with you is the sort of connection between the alternative investment funds and the traditional investment funds. And this is something, sure, I guess you don't talk about very directly, even though your work sort of lays out the connection. For instance, BlackRock acquiring GIP in the anticipation of state subsidies to the infrastructure sector is an example of that. But even prior to that, I think the rise of the asset managers in alternative investment funds that went into grabbing infrastructure was partly to hedge the sort of market risk of putting the entire capital into the traditional asset sector. So they are not as separate as one tends to think of when one looks at the operational side of what the asset managers do in these both sectors.
Yeah, yeah, no, that's absolutely right. I mean, I think it is. Yeah, just I mean, I don't have a huge amount to say on that because I completely agree with what you've just said. Let me just say a couple of things. So the first is that while they are definitely not completely different, and while they are definitely not separated always in practice, insofar as you definitely have asset managers who do both of those things. They do the kind of traditional mainstream investment in financial assets, but they also do alternative investment in real assets. I still think it's important to you can learn a lot by analyzing them separately and thinking about the different sort of dynamics, the different fee structures, the different kind of business principles that apply in each case, because I think they do look quite different in practice. And I'm happy to dig more into that if need be. So that's the first thing I'd say. The second thing I would say is that absolutely it's true what you were saying, that historically alternative asset management, investment in real assets, as I'm talking about here, it emerged, as you say, in part as a way to kind of hedge some of the risks associated with mainstream investment management. So insofar as asset managers were invested predominantly or exclusively in public equity and bond markets, that they and their clients were very, very exposed to market downturns, to bear markets in global equities and bonds. And of course, many investors like to be diversified. They like to have their risks diversified and hedged to the extent that they like to have what's often referred to in the industry as non-correlated risks. So the idea there being that even if you have lots of assets that will lose value when global equity and bond markets fall, that it might be nice to have assets that where the returns do not fall in those instances. And things like real estate and infrastructure have often been thought of as very good kind of risk diversification mechanisms in those cases. And then third and finally, I think what we've seen in recent years is that some of the best performing asset managers, some of the asset managers who have generated the strongest returns, both for themselves and for their clients, have indeed been alternative asset managers, the Blackstones, the Carlyles, the Macquaries, and so on. And I think you have a company like BlackRock, which has always historically been very, very focused on traditional asset management. So investing in financial assets, doing so very, very passively through these big index funds, and charging very, very low fees. So it's kind of a low cost, high volume business, have kind of looked somewhat enviously at what's going on in the alternative space and said, okay, we want a piece of that. And so, as you say, BlackRock announced last year that it was going to buy one of the big players in this space, Global Infrastructure Partners, GIP. I don't think that acquisition has completed yet. It's had to go through all sorts of kind of regulatory approval processes, but as I understand it, it will go ahead. And that's absolutely about kind of BlackRock trying to get a piece of the pie of this other very, very attractive business.
One of the reasons why I discussed it is because I think it is very helpful to obviously understand one sector of an economy under capitalism. But at the end of the day, capitalism is also about an integrated whole. I mean, for instance, profitability itself is a relative thing, right? I mean, your work on energy, for instance, shows that if, and as it is true that fossil fuel industries have very high rate of return, let's say 15, 16%. I don't know what exactly it is, but given how ExxonMobil is aggressively expanding in Guyana, off the coast of Guyana, and so on and so forth, it's very, very clear that their rate of return is still very, very high. And also the existence of OPEC as a cartel to sort of limit production to keep up prices on the one hand, and then on the other hand, the sort of renewable market, which is sort of because government doesn't want to push up prices, and also existence of some levels of market in terms of existence of many, many players, along with whole range of technological innovations in China. Profitability is much lower, and so it is very, very difficult to drive money through the invisible hand of market from one sector to another. And I think to understand that is very important, because the mainstream orthodoxy is that there is this average rate of return and markets tend to equilibrate in each other. So insofar as moving capital from the low return to high return and so on and so forth. So yeah, that was why I think I wanted to bring this up.
Yeah, no, I think that makes total sense to me. And I think that, the only thing I'd say about that is obviously that one of the problems with that view that you do get this kind of equilibration of rates of return across sectors over time is that it just doesn't work out like that in practice. And obviously one of the big reasons it doesn't work out like that is that you get these enduring kind of concentrations of market power, where while it might be in theory, the idea might be that you have these pockets of very high returns, and that you would, in those situations, that capital kind of floods in, and so you get a readjustment of the relationship between supply and demand, and that brings down levels of profit. In practice, it so often doesn't work like that, because the barriers to entry in those particular industries are so very high, and they're often kept high by government intervention, cartelization, and all sorts of other things. And oil and gas is obviously a classic example of that, where OPEC is nothing if not a kind of a source of maintenance of market power at the global level, and it actively utilizes that market power to manage, to the best of its ability, the relationship between supply and demand in order to keep hydrocarbon prices and profitability very, very high.
I think this brings me to discuss a little bit about the state itself, because as we've discussed, like, market is clearly unable to tackle the vast majority of problems that we are facing, whether it's massive financing need in the green transition, or whether to deal with our demand for financing healthcare, financing pensions, so on and so forth. A lot of alternatives are available and has been available historically insofar as states coming into the economic sector, ownership, regulation in both prices, profit, and so on. It's a very, very broad question, but what do you think can be some of the roles of the state insofar as evicting rentierism from our economic life and make economic actors redirect them to the needs of ordinary people in general?
Yeah, that's a very good question. I mean, I think there are things absolutely that governments can do. I mean, I think obviously almost a prior question to that is why would you want governments to do that? So why would you want governments to help reshape capitalism in a direction that is less dominated by rentier interests? And I think there are all sorts of reasons for that. And I think that you can look at an economy like the UK as a very good example. So I in my work, I've argued that the UK is almost a quintessential example of a kind of a rentier capitalist economy where rentiers are so very, very dominant, and the economy is so very, very oriented towards rentier interests and activities. And it's absolutely no coincidence that the UK, during the period in which it has become more oriented towards rentier interests and activities, has become a very, very stagnant economy, characterized by very low growth rates, low rates of productivity, and B, a very, very unequal economy as well. All of that is readily explicable by its shift towards a more rentier type economy. So I think there are very, very good reasons for wanting that to happen, over and above those that we've already talked about earlier in relation specifically to asset managers and their kind of extractivist business model, which in a way kind of typifies rentier capitalism more broadly. So what can governments do? Well, I think that, let's say two or three key things. Well, let's focus on two. So one, I think, which is very, very important, is the question of taxation. So, as I'm sure all of your listeners know, tax policy is very, very important. It not only do the taxes that exist in a particular society impact the amount of money that owners of assets and generators of income are able to keep for themselves rather than having to hand over to the state. But because they do that, they also nudge economic actors in different directions. And what I mean by that is that if, for example, there are very, very high rates of taxation on labor, on the work that we perform and the income we generate from our labor, whereas there are very, very low rates of taxation on, for example, asset ownership and on the income that is generated through asset ownership, then of course, all other things being equal, economic actors will be incentivized not to perform, not to be employed, and to focus their time on working as workers, but to own assets and to try to extract capital from to extract income from those assets as rentiers. And so taxation policy has played a very, very important role historically in leading particular economies in a more rentier type direction. And the UK is a very, very good example of that. So it has and has now for several decades had very low capital gains taxes that which means that which in and of itself is very, very friendly to rentier type interests. And then within particular sectors like pharmaceuticals, like the creative industries and so on, and also within the oil and gas sector, there are tax privileges that apply that again have been very, very friendly to rentier interests. So it doesn't take a genius to think, well, actually you could do quite a lot by playing with tax policy, by shifting tax policy in such a way that it becomes less remunerative to be a rentier and more remunerative to be a productive capitalist and or a productive worker. So tax policy is one thing. And I think the other obvious thing is simply ownership transformation. So a rentier capitalist society is nothing if not a society in which private ownership of assets is the default ownership model. So what I mean by that is that a rentier capitalist society is one in which essentially everything, but if not everything, then pretty much close to everything that can be owned by private actors indeed comes to be owned by private actors. So if you want to focus on the main reason why a country like the UK is today a quintessentially rentier capitalist society, sure, tax policy has played a very important part of that. But more important is the fact that since the beginning of the 1980s, the UK has essentially privatized everything that can be privatized. It's privatized housing, it's privatized water and wastewater infrastructures, it's privatized telecommunications, energy, all the rest of it. And so everything that was previously owned by the state has increasingly come to be owned by private sector interests. And it strikes me that it's very, very difficult to envisage, in the case of a country like the UK, a meaningful shift away from its existing rentierist disposition, unless you contemplate some pretty substantial ownership transformations. Now, that doesn't necessarily mean central government taking control, nationalizing everything that was previously owned within the public sector. I think it probably does mean some nationalization, but there are probably certain types of assets that you could imagine being owned by municipal governments, and there are other types of assets that you can imagine being owned more by community groups, for example, whether that's land or certain local energy infrastructures and so on. But whatever that ownership transformation looks like, I think some significant shift away from the current model, which is a model where private ownership is the default model for ownership of everything, of pretty much everything, has to be part of what one has in mind when thinking about trying to reduce the kind of rentierist nature of existing capitalism.
I think I have two questions to wrap up, and if you could address them quickly. So I think following up from here is what you just spoke is almost a political question, whether we talk about fiscal consolidation versus some kind of fiscal expansion, stimulus, and so on and so forth, or whether it's ownership of physical assets. These are political questions, and one of the missing links that I feel, particularly in the global north, but we are seeing that in large parts of global south as well, although not as much as in the global north, is the presence of progressive parties. The Labour parties in the UK is completely, it's a hyper neoliberal party, and it's hard to imagine this transformation without talking about a party vehicle. And I'm asking this specifically because Western writers, and these two questions are my sort of critique from the global south, engaging with global north scholars, they are very, very suspicious, partly because they are writing to their audience who has been brainwashed for a generation that party is bad, party is Stalinism or whatnot. They don't talk about a party. They will talk about communities owning stuff here and there. They would talk about sometimes NGOs. They would talk about very abstract things of, communes and stuff, but they would be very, very reluctant to talk about a party. While we see political parties actually giving enormous, not just economic stimulus, but improvement in terms of real human capital in China, in Cuba, in elsewhere. So as someone from the global north, what do you have to talk about political transformations insofar as party politics?
Yeah, there's not a single word you said there that I disagree with, really. I mean, I think that certainly on the ownership question, but also I think on the taxation question, I mean, of course they're very, very closely linked to one another. It's very, very difficult right now to see any. I mean, Spain is potentially an exception, but I think that elsewhere in the global north, it's hard to think of a single country where you have a significant political party that would even contemplate the types of things that I've been talking about in the last 5 minutes or so. The UK is obviously, as you say, is one instance of that, but it's by no means the only instance. And it seems to me that you're completely right that you do need national political representation, party representation, to push forward in any meaningful way this type of agenda, whether that's within the energy sector, which is the one I've been looking at most recently, or more generally. And really, certainly in the countries I know best, which are the Anglo countries, so the UK and the US, you did have a brief window around 2017, 18, 19, where you did have significant political actors, Bernie Sanders within the Democrat Party, and then Corbyn within Labour in the UK, who and for a brief moment there was talk of exactly the type of things I've been talking about, and both of them talked about what they called a Green New Deal, where major public ownership of energy assets, particularly renewable assets, but not only renewable assets, was a central plank of what they were talking about. But of course, in both places, that kind of window got shut very, very firmly by the right wings of those centre-left parties. And to the extent that just a few years later, all of that seems kind of almost like a memory that almost didn't happen. And now the likes, people within Labour look back at Corbyn and it's kind of a source of ridicule as much as anything else, and shame within those parties. So I totally agree with you. I think that that is what's required, but it seems a very, very long way in almost all countries of the global north from any kind of political realization right now.
I think this brings me to my last question. It's a kind of, again, a critical engagement with the larger body of Western scholarship that is writing on Rentier Capitalism. And I'm not directing it directly on you because I haven't read all of your work. I have read a lot of your works, but I want to present this as a general critique of this category of Rentier Capitalism. And I think it's not a coincidence that a lot of these writings are coming out of the West. Obviously, the West has been terribly affected in the last 4 or 5 decades or so because of over-financialization and neoliberal capitalism. But I think part of it also has to do with the historical divide between the West and the global South, where years and years of capital accumulation, whether it's through settler colonialism, whether it's through sometimes very coincidental historical event of discovering cheap coal in the UK, or sometimes the catastrophe of the Second World War and its reconstruction by using surplus capital already accumulated in the West and so forth, not to also mention about higher levels of human capital. Capitalism has worked to some extent in the global North. It has been much more devastating in the global South. And the alternative in the global South has been outside capitalism, the more significant transformation in the global South, whether it's like educating millions and millions of people, or whether it's electrifying millions and millions of households through state-owned enterprises, or in terms of job creation and so on and so forth. So my question is, this body of Rentier capitalism, they sometimes willy-nilly present a picture that capitalism in its purest form is very productive. And that's where I see a sort of unity between mainstream neoclassical economics and this sort of heterodox economics, which sort of, it's not their intention. I am in full solidarity with this body of work, but they sometimes posit the problem as saying that, well, the only problem is this over financialization. If somehow we can go back to that golden age of welfare capitalism in Europe and Keynesian capitalism in the US, things are sorted. But things were sorted only for this enclave of the global North. I mean, large parts of the global South, Keynesian capitalism was not even possible because of capital's uneven development, whether it's labor production. So what's your response to that criticism?
Yeah, again, I mean, I totally agree with that. I would say that, I mean, you said you weren't directing it specifically at me, but I think that my work to one extent or another, actually, it does it does fall prey to some of these problems. I think that critique is applicable to my work to one extent or another. So I would totally agree with what you were saying about kind of the uneven global structural roots of the so-called golden age of capitalism that's completely true. I guess what I would say is that I think that there is work out there, and in a way, it's kind of the best of the work, I think, on rentier capitalism that precisely makes the point that rentier capitalism in the global north continues to be a form of kind of rent extraction from the global south. And so the flow, and I've tried to, to be fair to myself, I tried to point that out in the book about asset managers, where I make the point that, a lot of the investment that is occurring in the global south by these asset managers is essentially about funneling profits from the global south to asset managers and their clients in the global north. But aside from my work, I think a lot of the best work on rentier capitalism is really focused much more explicitly than I am on that extractivist relationship. And I can think of two good examples of that. So firstly, there's the obvious point that you know a lot of the profits made by finance capital in the global north is based on the huge levels of both sovereign and private debt in the global south. So you now have many sovereign governments in the global south who, as they were in the 1980s, are again struggling under enormous debt servicing obligations that are crippling for those governments and for the economies of those countries. You don't need me to tell you that, but that's obviously true, and that's a kind of a fundamentally rentierist relationship. It's very much like the kind of the international model of rentierism that Lenin wrote about in his book on imperialism. And then the other obvious example, and Teo Rio Francos is very good on this. He has a great line. I can't remember the particular line about extractivism, or in my terminology, rentierism, is essentially the nature of the relationship in the existing world between global north and global south. And her focus there is on natural resources, right? So it's on looking at on the global south as the site for the extraction of raw materials that enable capitalism in the global north. And so I think that type of work is fundamentally about showing how global rentier capitalism it continues to be based on those uneven extractive relationships at the international level in a not dissimilar way to as was the case in terms of labor exploitation under the global age, under the age of global kind of so-called productive capitalism.
Yes, a lot of our focus is to think about the global economic system, keeping in view the global south. And I think two of the things that we have problems with is that there has been a phase of capitalism which was enormously productive to people at large. This is a narrative that resonates on enclaves of the global north. And secondly, I think I just blanked on the second point that I had in mind. But anyway, I think this was a very, very good discussion. Brett, thank you for so much for your time. And I hope we can have you again next time to discuss many other questions that I had.
I'll be delighted to. Thanks for having me. I really appreciate it.
Hi, my name is Ayushman. I, along with Jyotisman, have started this platform. In the last 2 years, we have tried to build content for the left and progressive forces. We have interviewed economists, historians, political commentators, and activists so far. If you have liked our content so far and want us to build an archive for the left, I have two requests for you. please do consider donating for the cause. Link is in the description below. Also, if you are not able to do so, don't feel sad. You can always like our videos and share our videos to your comrades. Finally, don't forget to hit the subscribe button.